What is the role of the IMF? The International Monetary Fund (IMF) is a global financial organization established in 1944 during the post-war economic revival drive. The main aim of the establishment is to manage exchange rates and to ensure a quick recovery from the economic devastation of the war. Almost all members of the United Nations are members of the IMF. But what is the role of the IMF per se? When the Bretton Woods exchange rates management system was adopted, J.M. Keynes and Harry Dexter White played a very crucial role in the development of the system. The idea was, and still is, that stable exchange rates among the member states of the United Nations Organization, as the UN was then known, would increase standards of living. That goal automatically saddled the IMF with the following functions: fostering international monetary cooperation among members, promoting exchange rate stability, helping to deal with and regulate the balance of payments adjustments, assisting during an economic crisis by providing distressed international coordination, including loans and advice. What IMF practically does. To perform the functions listed above, the organization in practice does the following. 1. Surveillance and monitoring global economic conditions. Because of the IMF's rare ability to review the past and preview the future of the economies of states, it could generate reports on each economy, pinpoint areas of weakness or possible danger, such as an unbalanced economy burdened with large current account deficit or excess debt levels. By keeping a tab on the pulse of each economy, IMF gives invaluable analytical reports such as the yearly World Economic Outlook, Global Financial Stability Report, and Fiscal Monitor. Number 2. Advises member countries. The IMF usually suggests ways to avert the foreseen economic problem or how to come out of the current crisis. It has developed standards that members should follow under different circumstances. Provides soft loans to members with financial crises. From the members' contributions, application fees, and other revenues generated by the organization, the IMF has hundreds of billions of dollars as loanable funds. The organization may be willing to make such available loans to the needy as part of a financial readjustment. Over $180 billion of such loan has been arranged in bailout packages since 1997. Even powerful nations like the UK benefited from such loans in 1976 when the pound sterling was under pressure. Some $110 billion was granted to Greece in the 2010-11 economic year. Giving conditional loans/structural adjustment. To prevent recklessness on the part of leaders, the IMF would usually insist that certain criteria be met. These may include tightening of monetary policy to reduce inflation, increasing tax to reduce the deficit, supply-side policies in form of privatization, deregulation, and improved tax collection, removing price control to free the market forces interplay, removing barriers to ensure free trade, currency devaluation to reduce current account deficit, and so on. The roles of the IMF keep changing according to the scene of the world. This has become conspicuous since the 2008 global economic crisis, when an IMF surveillance report hinted at the looming financial crises. But the world leaders regretted it and paid heavily for it. Thank you for watching this video, and don't forget to subscribe, comment, and turn on the notification bell.